How living in these 5 states triggers a secret double tax. On your Social Security benefits, right now, this month, if you're collecting Social Security and living in one of 5 specific states, you're paying taxes twice on the same check. And I'm not talking about some small technical difference. I'm talking about losing $3,200 to $7,800 extra per year that retirees in the other 45 states don't pay. The IRS takes their cut. Then your state takes theirs. Same money. Taxed twice. And here's what makes me furious. Most CPAs don't even mention this until after you've already filed, because they assume you know. You don't. Nobody tells you. So let me tell you exactly what's happening. In the next 13 minutes, you're going to learn 5 things your state desperately hopes you'll never figure out. 1. The exact 5 states that double tax your Social Security and the weird historical reason they're allowed to do it. 2. The specific income threshold where this double taxation kicks in and why it's different from the federal calculation. 3. The reverse cliff loophole where earning $1 less can save you $1,400. I'll show you the exact math. 4. How to legally restructure where your income comes from to cut your state tax to 0 without moving. 5. The one move 95% of people miss that can eliminate this tax completely. I'm Grant Ellison. I spent 15 years inside institutions like Morgan Stanley and MetLife, and what I'm about to show you is stuff we knew, discussed internally, and never once proactively explained to clients. There's no incentive to reduce your tax when your tax bill creates transaction volume for the people managing your accounts. I got tired of that system. Let me tell you about Linda Patterson. She's 68, lives outside Denver and Lakewood, Colorado. Retired elementary school teacher, pension from the state, about $31,000 a year, Social Security, $24,000 annually, and she pulls maybe $18,000 a year from a brokerage account to cover extras. Total income, about $73,000. She's not wealthy, she's comfortable. Here's what happened that she didn't see coming. She knew Social Security might be taxable at the federal level. Up to 85% of your benefit can get taxed federally if your provisional income crosses certain thresholds. She was prepared for that. Her tax guy told her she'd owe federal tax on about $20,400 of her $24,000 benefit. She budgeted for it. What Linda did not know, what nobody told her until April 15th when she's signing her Colorado return, is that Colorado is going to tax her Social Security all over again. Not the same calculation, not the same thresholds, a completely separate state tax on the same benefit the IRS already taxed. Colorado has something called the pension and annuity subtraction. Sounds like relief. And for some people it is. If you're 65 or older, you can subtract up to $24,000 of pension income from your state taxable income. But Social Security is not considered a pension for Colorado purposes. It doesn't qualify for that subtraction. So while Linda's teacher pension gets protected, her Social Security gets hit with the full 4.4% Colorado flat tax. She paid federal tax on $20,400 of her Social Security. Then she paid Colorado state tax on the entire $24,000. Same money, taxed twice. That cost her an extra $1,056 in state tax she wasn't expecting. And when she asked her CPA why he didn't warn her, you know what he said? Well, you live in Colorado. That's just how it works here. Like it's the weather. Like there's nothing you can do. Except there is. And we're going to get to exactly what. Here's what's actually happening at the federal level first. Social Security taxation follows the provisional income formula. You take half your Social Security benefit, add all your other income, pensions, wages, interest, dividends, capital gains, IRA distributions, everything. And if that combined provisional income exceeds $34,000 for single filers or $44,000 for married couples, up to 85% of your Social Security becomes taxable. That's the federal rule. Every state starts with that calculation as a baseline, but 13 states decided to tax Social Security at the state level too. Most of those states have meaningful exemptions based on age or income. 5 states don't. 5 states offer no real protection, they just tax it. Colorado, as we just covered, explicitly excludes Social Security from its pension subtraction. Even after 65, the protection phases out at higher incomes. Minnesota, they have a Social Security subtraction, but it phases out completely if your provisional income exceeds $81,180 for single filers or $103,930 for joint filers. Sounds high? It's not. That includes half your Social Security in the calculation. So a couple with $35,000 in Social Security, a $40,000 pension, and $15,000 in IRA withdrawals is already at $107,500. Zero subtraction. Full state tax. Minnesota's top rate is 9.85%. Montana taxes Social Security to the extent it's taxed federally. No meaningful exemption above $25,000 for singles or $32,000 for joint filers. State rate up to 6.9%. New Mexico, no exemption at all if your income is above $100,000 for joint filers or $51,000 for single filers. New Mexico's top rate is 5.9%. Vermont taxes Social Security to the extent it's federally taxable, with exemptions only if your federal AGI is below $50,000 for single or $65,000 for joint filers. Vermont's top rate, 8.75%. That's brutal. In all 5 of these states, they're literally just adding back your already federally taxed Social Security benefit to your state taxable income. It's double taxation. It's the same dollars, once to the IRS, once to the state. And it's completely legal because Social Security isn't protected income under state constitutions the way some pensions are. Let me show you how this hits 3 different households. Tom and Susan, both 66, live in Edina, Minnesota. Tom has a $48,000 pension. Susan has $22,000 in Social Security. Tom has $18,000. They pull $25,000 a year from their IRAs. Total income, $113,000. Their provisional income, $133,000, way over Minnesota's threshold. They pay federal tax on 85% of their combined $40,000. Social Security, that's $34,000 taxed federally. Then Minnesota adds that same $34,000 back into their state return. Costs them an additional $1,819 in state tax. Double hit every year. Barbara, 71, Missoula, Montana. Social Security, $19,200 annually. Small pension, $14,000. Part-time bookkeeping work, $8,000. Provisional income, $50,800. She pays federal tax on 85% of her Social Security, $16,320. Montana taxes the same $16,320. Costs her another $964 in state tax on top of federal. She's living on $41,200 and paying nearly $3,000 total in tax on that one income source. James, 69, Burlington, Vermont. Dividends and capital gains, about $95,000 a year. Social Security, $32,000. Provisional income, $111,000. Federal tax on 85% of his Social Security, $27,200 taxed. Vermont adds that $27,200 back in. At 8.75%, that's an extra $2,380 in state tax. The Vermont double tax on his Social Security? Pure insult. So what do you actually do about this? Here's your step-by-step checklist. Step 1. Determine if you're actually affected. Pull up your most recent tax return. Look at Form 1040, line 6B. That's your taxable Social Security at the federal level. If that number is greater than 0 and you live in Colorado, Minnesota, Montana, New Mexico, or Vermont, you're paying double tax. Step 2. Calculate your provisional income. Take half your annual Social Security benefit and add every other dollar of income, wages, pensions, IRA distributions, interest, dividends, capital gains, even tax-exempt muni bond interest. Write that number down. Step 3. Run the state-specific threshold test. Go to your state's revenue website and search for the Social Security subtraction form. Minnesota uses the M1PR, New Mexico uses the PIT-80J, Vermont uses Schedule N112, Colorado uses the DR0104AD. Each one shows you exactly where the exemption phases out. Compare your provisional income to that number. Step 4. Restructure your income sources. This is the big one. If you're pulling from a traditional IRA, every dollar adds to your provisional income. But Roth IRA distributions do not count toward provisional income. They're invisible. So if you've got money in both traditional and Roth accounts, pull from the Roth first. You can take $30,000 from a Roth and it won't move your provisional income needle at all. If that keeps you under your state's threshold, you just eliminated your state Social Security tax entirely, without moving, without restructuring your whole life. Step 5. If you're over 70 and a half and taking required minimum distributions from an IRA, use qualified charitable distributions. You can send up to $105,000 per year directly from your IRA to a qualified charity. That money never touches your income. It satisfies your RMD, but it doesn't add to your provisional income. For someone in Vermont taking $20,000 from an IRA they don't even need, sending that $20,000 as a QCD keeps them under Vermont's $65,000 threshold. Zero state tax on Social Security. Now here's the advanced move 95% of people miss. If you're married and one spouse has significantly higher Social Security benefits than the other, say one gets $28,000 and the other gets $12,000, you can sometimes file separately at the state level to keep the lower earning spouse under the state threshold. Federally, married filing separately is usually a disaster for Social Security taxation. The threshold drops to zero. But in states like Minnesota, where the subtraction phases out based on combined income, splitting your state returns can create a scenario where the lower earning spouse qualifies for the full state exemption. You pay a little more federally, but you save more at the state level. Net result? You win. This only works in specific situations and you gotta model it carefully. But I've seen it save couples $1,800 in Minnesota. Here's the bottom line. You worked 30, 40, maybe 50 years paying into Social Security. That money's yours. And watching retirees in these 5 states get taxed twice on the same benefit because nobody explained the rules, that makes me furious. You deserve to keep more of what you earned. You deserve to understand how the system actually works. If this helped you, if you're sitting there realizing you've been overpaying for years, or you're about to retire into one of these states and you just dodged a bullet, hit subscribe. I publish videos like this every single week. And here's the specific reason I need you to share this video. There are thousands of retirees in Colorado, Minnesota, Montana, New Mexico, and Vermont who have no idea this is happening to them. They're paying this double tax right now, thinking it's just normal. Thinking everybody pays it. They don't. Send this to your parents. Send it to your aunt in Denver. Send it to your college buddy who retired to Burlington. Be the person who helped them keep an extra $4,000 this year. Thanks for watching. I'll see you in the next one.